Well, good afternoon, everyone. I'm Merit Jano, Dean of CEPA, and it's a real pleasure to be here with you and to see so many people here interested in the work of the CEPA's Center on Global Energy Policy. It's really a fantastic testament to the important work that the center is doing and to Jason's leadership in driving it forward in a very short period of time, a mere scant 3 years. The Energy Center, I think, has really become a major place for convening and engaging a critical set of policy issues around energy and the environment, and this gathering is another expression of that. So I thank you, Jason, and those you brought into our community. I just want to say that on behalf of CEPA and Columbia University, the issues that we must engage around energy, of course, are energy and the environment, looking at both the politics and the geopolitics and the economics, understanding the effects in different regions of the world. And I think all of that is work that is being done at the Energy Center and engages other parts of Columbia University as it must. Schools of International and Public Affairs, I think great schools have an obligation to bring into our community scholars and practitioners, experts and advocates, a wide range of viewpoints to engage critical issues. We must produce new knowledge and we must engage issues in a way that have impact in the world. And I think all of those things are hard to do, but the Energy Center under Jason's leadership is taking us forward with that ambitious agenda in a way that's very important to me and important to the university. So I welcome you here, I welcome you on campus. I look forward to this continuing engagement around environmental and energy, geopolitical and economic issues touching all parts of the globe. Very good to see you. I look forward to mingling with you and learning from this afternoon's discussion. Thank you.
Thanks so much, Merit. I have to say, it is a really exciting environment to be part of Columbia and CEPA right now. The amount of momentum and excitement and enthusiasm for what's happening at CEPA and what the potential is pretty extraordinary, thanks to the leadership that you've brought since you took over as dean. So I'm really proud and privileged to be a part of it. Moving on now, we're going to talk about how the global natural gas market is changing, looking across different sectors of it with representatives from government, from industry, from the NGO community, and taking a global perspective, bringing in perspectives from people who've traveled far and wide, including as far away as Australia, to be with us here today, and people who are also in the business of thinking about how US natural gas might impact the rest of the world. So with that, I'd like to ask the next set of panelists to come up: Nick Butler, Peter Coleman, Fred Krupp, Charif Souki, and our moderator, Mona Sutphen. I will let Mona briefly introduce the panelists, but many of you know Mona Sutphen. She's a partner at Macro Advisory Partners, the former Deputy White House Chief of Staff to President Obama. She also served in the Clinton administration on the staff of the National Security Council at the US mission to the UN, a member of the President's Intelligence Advisory Board. I'm very lucky to call Mona a friend and just want to thank her for all the advice and help she's given both to me and also to the Center on Global Energy Policy as a member of our advisory board. Please join me in welcoming Mona and the rest of our panelists to Columbia University.
Can you guys hear me? Is this on? Is this? Oh, there we go. Okay. Fantastic. So thanks, Jason, for the introduction, and thanks, everybody, for attending this conversation. I'm really excited to have a little bit of a dialogue about the global gas market. So as Jason mentioned, the way I think we'll structure the conversation is about 30 minutes, but please send in your questions. I'll try to get to them toward the end for sure. And talk through some of the salient issues, and I hope people will have lots of questions for the panel. So I'm going to do a couple of just very quick introductions of our panelists, and then we'll jump right into it. So, but obviously you have long form bios in your program. So first, We have Nick Butler, right here in the second chair, who's a visiting professor at King's College London and founding chairman of the King's Policy Institute. Previously, he was at BP and was a senior policy advisor to the UK Prime Minister, and also is a regular writer on energy issues for the Financial Times. We have Peter Coleman here, who has over 30 years experience in the global oil and gas industry in China and the Americas, essentially, as I was reading, everywhere in the world, as far as I can tell, right? Pretty much, yeah. And was managing director and CEO of Woodside since he got to the company in 2011, and before that, 25 years plus at ExxonMobil. Fred Krupp, I think, kind of needs no introduction in some respects because he's guided the Environmental Defense Fund for over 30 years, essentially, since when you were, what, a child laborer at the age of 12 or something.
Thank you for that.
Yeah, well, you know, and really a recognized thought leader in building EDF into one of the powerhouse environmental organizations in the world, and a thought leader on sustainability in the energy space and the environment. And Charif Souki, who's a great friend of the Energy Center. We've been on the advisory board together. Who is now director and chairman of Tellurian Investments since February of this year, but I think is also well known for founding Cheniere in 1996, and obviously started his career in the financial services investment banking industry in the oil and gas industry. So with that, I'm going to turn right to it. So I thought it might be really interesting just to start with the outlook for the market. Really this fundamental question you got into in the last panel, supply and demand dynamics in the global natural gas market, because we've all been watching and waiting and anticipating this boom in supply from the US and Australia, and we're lucky enough to have Peter and Charif with us, who are really the drivers of a lot of that change in these two markets. And so I really wanted to start with the two of you and get a sense of how you see the market unfolding. So Peter, I'm going to start with you, which is, I saw the other day that Woodside has canceled a really large LNG project. I'm sure you're getting this question all the time. And your comments about maybe phasing these projects, making them slightly smaller. I'm just curious about whether or not you think, I think in a lot of people's minds are wondering, is there going to be enough demand for all the LNG that in theory is out there with all these projects? So I'm just curious what your outlook is, how you think about it, and really the most important question is, over what time horizon do you see things balancing out?
Well, we actually delayed a project.
Okay, sorry.
So let's, much to the relief of some investors. So we heard it on the previous panel. Of course, the appetite for long-dated capital projects at the moment is very low in the industry. We need to have a lot of certainty around both our ability to deliver, but also the price outlook for it. Just on the supply-demand, look, we all get sucked into the same supply-demand forecast. We all kind of pretty much use the same consultants, and then we have an in-house economics team who tell you they deliver an independent view, but of course they get biased by what's happening in the marketplace. They read the news as well. And so what it says to us at the moment is what's been a very orderly market, a very orderly investment thesis within the oil and gas industry around LNG. It's had a significant barrier to entry, both IP with respect to technology, but also with respect to balance sheet capacity, has now been totally disrupted. And so people are now making investment decisions on a future that is not quite as certain anymore. And it means the buyers themselves, who were part of that certainty in the future, and those buyers in many instances were utilities. Utilities that were quasi-monopolies in their home country that had some certainty about outcomes and their ability to pass on price, themselves are now sitting on the fence saying, I'm not sure that I want to play or get into the pool anymore. And so where we are, I think we're at an inflection point. I think LNG and gas has to earn its place in the energy mix. Everything we see is this growth in energy demand, and that's true. That's very true. That will continue to happen as the world urbanises. But the reality, though, is once you take the layers down from that, there's an inherent assumption that gas is going to play part of that. The reality is the buyers or the users of that energy won't wait for us. And so if we sit on the sideline and say, hey, we're not going to invest in these projects for a long period of time, we're going to wait for a price to tell us before we do it, well, guess what? Guys like Charif will come in under our radar screen and he'll develop a different business model because he sees an opportunity. And that's been the history of the oil and gas industry. We reinvent ourselves about every 10 years. And every time somebody thinks they've got a market cornered, or they can sit on the fence and wait for price to help them out in an investment decision, somebody else will come along and take that margin away from you. So, as we look at the demand in the future, it's ours for the taking in the industry, but we must earn our way, and we must fundamentally change the way we think. We've had a cozy 10 years of sitting on the fence, and the buyers have come to us as sellers. We now need to get on our bike. We need to put ourselves in the buyer's shoes. And I think Patrick mentioned it earlier this afternoon. We need to go further downstream. We now need to think about how we start to create market. We can't wait for market to be created for us anymore. We need to think about how we create market.
Yeah, very interesting. And I actually can I ask you one follow-up question just before I move to Charif, which is the role of China in and Chinese growth in how you see this market evolving. Is it like one of the central issue? Is it? Sounds like less really. That it's more a structural market thing than a.
Well, we look for disruptors in the marketplace, and there are 3 potential disruptors. Dan mentioned before, it could be interest rates. The industry in the US in particular has benefited from QE2. And there's a question in my mind as how long investors are going to be willing to take single-digit returns. This is an industry that historically has needed 12 to 15% return on equity. And the business models in play today, for a lot of that industry, are negative to single-digit returns. So there's a question in my mind as how long would that last, and I can't tell you. The other part then, of course, is regulatory change. And we're seeing that things that are quite irrational to ourselves in industry are quite rational to many others in the marketplace. And if you think about Germany's decision post-Fukushima to go to coal, was very politically driven, but made a lot of sense inside Germany, but nobody else could understand it. So you're looking at these disruptors. China's in the same place. In our view, there are 2 things happening in China. Firstly, Chinese, as the middle class comes in, the Chinese are demanding clean air, clean water, safe food. Very simple, clean air, clean water, safe food. They don't have any of those. And that will change. They will make that change, and you're starting to see regulatory reform happen today. We talked about the number of electric cars that are required in major cities. You're hearing now more about the fact that new build coal-fired power stations are not going to get approval. So those sorts of things will happen, particularly in an economy that can move that around. The other thing that will change is the Chinese have LNG at the border now. So they've opened up the marketplace. They have import terminals. They can't distribute the gas. They can't distribute it because they have a monopoly system within the country that is preventing the gas distribution getting to consumers at a price that the consumers deserve. That will change. That will change. And those cross-subsidies will change, and you will see a different type of buyer come into the marketplace. And we think the next 10 to 20 years will see the emergence of the super city. You will no longer see monopoly infrastructure owners, state-owned enterprises on a pan-country basis. We think you'll see the emergence of the super city. So all of those things will start to play in. But I think the Chinese will unlock this market. It's just they have to be a believer that gas is going to stay low enough in price for long enough, and then they'll make those structural changes.
Very interesting, very interesting. So Charif, switching to the U.S. Picture, it's kind of tremendous to watch LNG exports leave the lower 48, which, as we were saying earlier, nobody really ever saw coming. Obviously, you saw coming. So I'm just curious, and I see you've started a new company in this space at the same time that prices are down. So I'm curious about your thinking about the outlook, how you think about what Peter had to say, where there's commonality, where there's difference.
I think the first thing about our business is it's now in search of a pricing model. We've gone for a long period of time of trying to figure out, well, except in the United States where we had a market pricing. The rest of the world, we went through oil indexation, and then we said oil indexation doesn't work very well. And we started, in Europe particularly, to get away from oil indexation and to markets as well. But they haven't really taken hold yet. So if you put a buyer and a seller of LNG today, or of natural gas actually, almost anywhere in the world today, they can't agree on a price that would be sustained for the next 20 years. So obviously, with $40 oil prices, everybody likes oil indexation with a cap. Mm-hmm. And of course, the producers say, don't want oil indexation with a cap. Right. If we're going to take it when it's low, we want it when it's high as well. So nothing is happening. The Russian pipeline to China is not working. It's not happening. Nobody's agreeing on pricing. On LNG prices, you can't not put a buyer and a seller together, willing, both of them, to make a deal and tell them and have them agree on what the pricing mechanism is going to be. So one of the major disruptors that is coming now is that between 30 million more tons in Australia that's coming over the next couple of years, it hasn't arrived yet, and 60 million tons from the United States. So altogether, 90 million tons, about 13, 14, 15 BCF a day that is arriving on the market. With the existing volumes, it means that in 4 years, or less than 4 years, in 3.5 years, on any given day, you have a choice of 1 out of 11 cargoes. So that's a 35 BCF physical market on a global basis that is sitting on the water, perfectly correlated by transportation prices, which are very transparent, and coming from 3 major sources: Australia, Qatar, and Gulf Coast of the United States. That is going to change how everybody looks at everything. So you will have a real spot market developing and a real spot pricing. And people forget that the purpose of a pricing mechanism is to send a signal from the buyer to the seller. I need you to produce more or stop. I have enough. And on that basis, you will be able to have complete transparency. And you're going to have to make your choices about where you want to take your long-term infrastructure commitments. Until that is resolved, I don't see any major changes. But while we're all thinking about what is the price that we would like and whether we would agree with the buyers or the sellers and everybody can get around the table, the spot market is coming and is becoming more and more real. And you have today prices that are uncorrelated to oil prices in Europe and in Asia, not necessarily correlated to each other either. Mm-hmm. But you have about 70 to 75 million tons of additional volumes that are going to come over the next 3 or 4 years, and then nothing. So we have oversupply today. We don't have oversupply in 2021 and 22. Yeah. And if we don't start seeing people taking decisions today for what they want to do in 2021 or 22, we're going to find ourselves again short. Mm-hmm. About 4 or 5 years down the road. Yeah. So that's why I'm looking ahead and I'm saying there's nothing happening. Patrick talked about it earlier. Only 2 projects on the oil side were sanctioned in the last 12 months. Nothing got sanctioned on the gas side. Mm-hmm. Peter just delayed his project.
Yes, delayed.
But I would challenge Peter to find a pricing mechanism that works for him and that works also for his buyer.
Very interesting, and actually to the point of the buyers, actually, I wanted to bring Nick into this because I'm just curious how Europeans think about what's getting ready to unfold, and I'm always struck by this psychology in Europe that there's a very strong public sentiment, seemingly to us, against fracking. On the other hand, a potential huge opportunity when it comes to dependence on Russia for natural gas, and how you think Europeans are likely to react to this new dynamic. Is it going to be kind of the place that all this gas goes? And then also, what does that really mean for the Eastern Mediterranean and some of the projects that are, in theory, out there that are more expensive than?
Okay, thanks, Mona. That's an awful lot of questions.
I know, sorry.
Let me take them one at a time. First of all, I think you have to start by looking at what's happening in the European market for gas. And there are 2 problems. The first is demand, and the second is supply. On the demand side, demand is down. It's been down for the last 10 years. It's now down, I think, about 15% from the peak. That is partly the sluggish economy. It's partly increased efficiency of use, but it's mainly down to the fact that public policy has mandated renewables, which have taken a large part of the power market away from natural gas that people used to hold and believed might continue. So that's the demand side, and I think that will continue to fall. I think we are actually well past peak gas in Europe. And then on the supply side, Europe is overwhelmed by supply from all sides. It's helped on by LNG, but the main driving force are the Russians. I was looking at the Gazprom numbers. Gazprom has taken the brunt of all that fall in demand over the last 10 years and is determined now to keep its market share. Gazprom has failed to complete the deals that it hoped to do in China. They haven't been signed. They haven't been signed in any way. There's no agreement on the route or the volume or the investment structure or the timing. And Gazprom will now get no revenue from sales to China until the late 2020s at best. Therefore, they're totally dependent on Europe for their revenue. And that's why they are pressing to both hold on to the market they have and to expand it by building Nord Stream 2. And I agree with the speaker from Total that it probably will go through because it's a political decision in Germany. And Germany see it as part of their long-term relationship with their major neighbor. So supply and demand suggest to me that prices are going to fall, and I don't see that changing very quickly. I think it leaves assets such as the Eastern Mediterranean absolutely stranded. I think Woodside were very wise to pull out of that. I think it leaves fracking a lost cause in the UK, despite the wishes of the government that it goes ahead. And I don't see it being developed in much of continental Europe because it's just not needed and the prices don't support it, even before you get to the environmental arguments. So I think Europe is a complex market, and I don't think it's going to help the world price go up at all. Quite the reverse.
Interesting. And actually, to that, in the realm of other kind of risks out there, I'm curious, Fred, whether or not you think we've seen kind of the price of renewables come down. Is there also this threat that the price of renewables continues to come down to the point that this market, to Peter's point, it's just not there? It does. Mathematically, it just doesn't make a lot of sense, or is there a point at which, no, in fact, the kind of curve just can't continue at the same rate that it's been at?
Well, Mona, I prefer to think of it not as the threat that the price of renewables come down, but as the promise that the price of renewables have come down.
Exactly.
It's amazing. Renewables, solar panels have come down in price 80% over the last 5 years. People have figured out how to make wind power also somewhat less expensive. The curve isn't quite as steep as with solar. And so, yes, looked at from the perspective of the natural gas industry, I suppose it is a threat. And it's a good thing for the world that clean energy is truly clean energy is getting cheaper. I think that's a trend that's going to continue. On the other hand, surprised by the comments about Europe a little bit, because like China, Europe is burning a lot of coal. Germany is burning a lot of coal. So if there were increased demand for less carbon to be put in the atmosphere, that would create more opportunities, certainly for renewables, which would be my first choice. But I think natural gas would be also a very good exit ramp to get off so much damn coal that's being burned in Europe. So there is, I think, a need for lots of lower carbon sources, both in Europe and China. So, I think depending on the environmental policy that Nick knows more about Europe than I do by a lot, I'll stipulate to that, but it seems like there's some scenarios where demand for a lower cap in the European Union ETS could create demand.
Yeah, it's interesting. It's actually, do you want to jump in there, Nick?
Well, I don't think we're going to see Germany cut back on its coal anytime soon. I think the key issue in Germany is jobs, and the coal industry, I'm afraid to say, creates a lot of jobs. I think the one note of optimism, and you may or may not agree with me that this is a reason for being optimistic, is the UK, which is different from Europe in every way.
And maybe more so, depending on what happens.
May soon be legally different from Europe.
We have a closet endorsement of Brexit.
Right, I was just going to say, we're not endorsing Brexit, by the way.
I wouldn't dare. I think the slight reason for people in the gas business to be optimistic is that the program in the UK for new nuclear power is a failure. And EDF, the French new energy company, has not been able to live up to its promises, which would have the first station producing power in order that we could cook our turkeys for next year's Christmas, as they said. They look like the turkey at the moment. And I think that if nuclear is postponed for a considerable period, which I think is now really quite likely, there will be a gap in the UK market, and that will provide some relief to the gas producers. But not that much, and I think the price will be low. And I'm really surprised that Chris Smith in the last panel was so optimistic about the prospect of US LNG exports into Europe. Mm-hmm. I think that we have more gas than we need already, and I think the price effect of major US exports would undermine the commerciality of those deals.
But I guess this is actually a good segue, because I wanted to get into the role of policy here, which could be one of the central drivers, as they were talking about before. We are at this inflection point where putting the thumb on the scale could have a major effect in exactly this question, because if there is an expectation in the UK, for example, you have to stick to these targets, or in Germany to fundamentally change, just the expectations game changes. The kind of cascading effect of that, I think, is something that I really wanted to get into with you, Fred. And one of the things that I'm really curious about, maybe we can start with kind of the US view, but I think there's a global view, or increasingly global view, which is this very polarized debate on whether or not natural gas is actually a bridge fuel. Is it a good thing, right? And in the US, you see, depending on where you sit, you get an absolutely no way, no how, because it's obviously for obvious reasons, but lots of other people saying, well, no, actually, to your point, relative to continuing to expand coal, say in Germany, this is much better than that as an alternative. Kind of where do you think that debate needs to get reconciled? Do you think it will get reconciled? Do you think it has to? Or do you think it'll just work itself out as different countries make different decisions based on?
Well, Mona, that's a great question. I think there is a real question about what's the length of the exit ramp, if natural gas is an exit ramp off of coal and off of fossil fuels in general. And I think the length of that exit ramp is going to be determined by how responsible industry is and how supportive they are of public policy to make natural gas better from an environmental standpoint than it is now. Right now, it's not a well-known fact, but people are discovering this. Aliso Canyon in California helped a lot of people discover it. Natural gas, when it's not burned, is an extraordinarily potent greenhouse gas. Over the first 20 years after it's released, 84 times more potent than carbon dioxide. The instant it's released, more than 100 times more potent than carbon dioxide. And so, you know, the industry is really shooting itself in the foot by not taking aggressive action to clean up these leaks. EPA just found out, just released a report within the last few weeks that the inventory of natural gas emissions in the United States, they had been underestimating by 34%. Which means the total leak rate in our country has gone up 11% between 2010 and 2014. And based on 26 peer-reviewed reports that EDF and industry participated in over the last 3 years that have been published, more to come, we know 10 times more about the leaks of natural gas than we used to 3 years ago. And what it tells us is this is the lowest hanging fruit in the field of public policy to get right. This is globally a fixable problem. You could reduce the leaks of methane from the oil and gas industry by about half, by 45%, for a trivial cost, 1/2 of 1%. the wholesale price of natural gas. And yet the American Petroleum Institute continues to fight even EPA's regulations on new infrastructure, let alone regulating existing infrastructure, which is the urgent need. Thankfully, President Obama and Prime Minister Trudeau got together a few weeks ago in March and said that they would expeditiously regulate existing oil and gas. Last point, just to make the point, if I told folks in the audience that we could lower temperatures around the world over the next 20 years by closing a third of the world's coal-fired power plants, many of you would probably say that would be a good thing, but how could we do that? That's closing a third of the world's power plants. That would be tough. Well, actually, from the oil and gas industry, if my colleagues in the industry could be more supportive, if the governments of the world pledged what the US and Canada have pledged, a 45% reduction in the leaks, which would cost a trivial amount, that would have the exact same effect on temperatures worldwide over the next 20 years as closing a third of the world's coal-fired power plants. It's unconscionable that more governments aren't moving to do this, that more people in the oil industry aren't, but forget about conscience and ethics. It's just bad business, because on this license to operate question, or the question you posed, of how long will that runway or exit ramp be, it's going to be a lot shorter in Europe and the United States and around the world if the oil and gas industry doesn't finally say, you know what, this is the smartest thing we could do, and it reduces the risk to investors as well.
Well, it's funny. Actually, I wanted to, this raises one question also I want to talk about, which is pricing incentives and pricing of carbon, and whether or not everybody on this panel actually thinks that there's a prospect for that coming down the pike. It came up in the previous panel. Whether or not, in fact, the regulatory certainty trade-off with an incentive that's a market-based one, is that something that seems beyond the pale, something that's never going to happen? I'm curious, Charif, what do you think about that, since we have that debate here, and also you, actually all of you, what do you think about that? Charif, you want to start?
Yeah, I think absolutely. Maybe I'm an optimist, but I happen to think that everything is set right now. I agree with Fred on everything he said. The only thing I disagree with is I think we should do both. Shut down a third of the coal power plant.
I was going to say, you don't want to let the coal industry off the hook.
I agree on that too, yeah.
So, I think he's right. It's unconscionable not to do both, and because it's possible to do both. One side is what he's noticing here and what EDF has done some studying on here. The other side is just walk around the streets of Beijing and New Delhi. There is a health cost to coal consumption that is becoming more and more apparent, and at some point we're going to have to do something about it. I say we. I mean, of course, I'm not Chinese or Indian, but they will have to address this issue, because if not, the cost will become unbearable. Yeah. So I think there is a setting on that side. And then, who would have thought 2 years ago that you would have heard Patrick Pouyanné talk about carbon pricing is a good thing, and signing a letter with 5 other companies to say we think it's a good thing, and having Chevron and Exxon wanting to be different, saying, yeah, maybe it's a good thing, but we'll do it our way, not their way. So all of a sudden, you have a consensus of people that say this is a good thing because we are going to sell more gas. This is from the majors. With all due respect to Nick, I don't agree with him. I don't think Germany can be the only one burning lignite when everybody else is becoming carbon conscious on a global basis. I think eventually Germany will have to follow the lead of England and do the same thing and get away from carbon. It's very good to put renewables, but when the sun doesn't shine and the wind doesn't blow, you still have to have something. And I think it's inherently going to be going towards this, and what is going to help is low prices, because in the old dictum, low prices take care of low prices. So I don't think in an environment of $4 gas prices in Europe today, you can draw the same conclusion that you drew 2 or 3 years ago from $12 gas prices. It's not the same thing. At the same time, you have places like Algeria where domestic prices of natural gas are $8 an MMBTU. It doesn't pay for Algeria to export their gas anymore. That is out of the world supply picture. Trinidad is going to run out of gas to sell. That will be out of the world gas picture. So at the same time as you have an oversupply today, you also have some dynamics that are developing with low cost that are curtailing supply and increasing demand. And those factors will be reflected over the next few years.
That's helpful. Nick, do you want to comment on that question?
Yes. I'm both pessimistic and optimistic. I'd be very pessimistic about the prospect of serious carbon pricing on an international scale. Europe has been way ahead of any other region of the world in promoting government-led environmental policies on climate change, but it has noticeably failed to agree on any effective carbon price. I'd be very surprised to see it imposed here in the US. And I think for the areas where the emissions growth is the most serious challenge in the next 20 years, and where the air pollution, which I agree with you completely about, is the most serious problem now, in those areas, I don't think putting up prices to consumers who are just emerging from poverty and just beginning to make use of energy, I don't think that's politically viable at all. I'm optimistic, though, because I see a lot of science that is beginning to change the pattern of supply. I think there was a story, just to quote one, and I could quote 20, one last week of Statoil combining storage with wind, so using storage at the foot of the wind turbine. Now, if you can do that, and they're just starting to do it, you can get away from intermittency, you can capture much more of the potential power from any wind turbine than you can at the moment. I think these sort of changes are what will alter the whole world market, and which actually, Charif, will get over this idea that we're going to go from low prices to high prices. I think that the industry is living in a delusionary world if it thinks that out of the current dip, it's going to go back up. And that is true both for oil and for gas.
Nick, I think there's a difference between putting a price on electricity and increasing the price to consumers and putting a steep price on carbon and other greenhouse gas emissions. And the difference is if you use the market accepts the price on the externality, grinds down the amount of pollution that's put in the system, and develops ways to keep consumer costs down with clean energy or lower emitting energy. And that's why in the United States we already have a modest price on carbon through the emissions trading system in the RGGI states here in the Northeast, in California, the biggest economy in our country among our states. That's why China has done 7 pilot trading programs over the last 3 years, and President Xi is committed to capping greenhouse gas emissions, introducing a nationwide emissions trading system next year in 2017. It's a way to price carbon, and done right, it will keep the electricity prices down, which I agree with you is absolutely fundamental from a political and fairness perspective.
But Fred, actually, I think, would you agree that the real challenge on emissions and climate change now is the growth in India? And how is that going to be changed by carbon pricing? I think what it needs is a low-cost, low-carbon alternative to coal that India can adopt. And they're trying. It's too slow. But I think that is the way forward.
Well, even in India, there's experiments going on with giving the rural poor incentive payments for sequestering carbon, but the 4 biggest emitters, of which India is not yet one, when you include land-based emissions, Indonesia, Brazil, the US, and China, there would be tremendous amounts of pollution that could be cut by pricing carbon, not necessarily through a carbon tax, although that is one way, but through any mechanism, whether it's carbon tax or an emissions trading system that effectively internalizes these externalities. You know, a lot of people are pessimistic about global warming, and I understand that. But consider the fact that until we price this externality, we haven't actually tried capitalism yet. We haven't tried the entrepreneurial system and used the profit motive so that the next set of billionaires that the world crowns are the ones who figure out how to produce electricity and the other goods and services we need, lowering the emissions profile. That's the central, it's not the only thing we need to do, but the central importance of why we need to price in these externalities.
Well, it actually gets to one thing that I wanted to get to, which is this question of technology innovation. And I actually want to come back to Peter and to Charif on this, because it struck me one of the things that we've been talking about is there's so much, I mean, this entire industry sector all the way across the board is going through so much tremendous change. It's unbelievable how hard it is to make decisions about what the future is going to hold. But there's so much disruption in the distribution of energy. We certainly see it in the United States. How do you think about the ability to make investment decisions, recognizing that the very method by which energy gets distributed, your point about the utilities as the central player, like how do you think about all that swirl and coming up with a path forward?
Well, you have a lot of sleepless nights if you're trying to work that out. And so you have to accept that the world's going to change in ways that you could not foresee, and then make non-regretted decisions and go down that pathway. I mean, there's a couple of things here, and it will play in, you know, often this debate, unfortunately, gets into people wanting to pick winners all the time. It's like, who's going to win the Super Bowl? Everybody has to get on a team. And it seems at the moment we're all deciding which carbon team we want to get on. And we need to get away from that, because the reality is energy security in these countries requires many different forms of energy. And as we've seen, energy over time in various forms will change in its pricing base and its affordability to society. So you can't have societies locking in on one form of energy and finding there's a disruption in that. Okay, that's called maybe Fukushima, huh? Yeah. Didn't forecast that one. And so those things come in. Suddenly a society has to adapt to a different energy model, and it can cause civil unrest in some parts of the world. This debate around carbon and carbon pricing, it's a difficult and complex one, and it's simply because typically it's the developed world having that debate and dragging the developing world along. The question is, where do you tax it? It's a tax. We call it carbon pricing. Who gets to keep it? And whatever you do, never let it get into the hands of government, and never let them put it into their revenue stream, because you'll never see it come back again. And so, you know, these are things, externalities we talk about. We need to be very careful, because many of the developing countries of the world, in fact, particularly those nations in Africa, are exporting countries. They're not consuming internally, so the model today is an internal consumption model, but it doesn't account for those countries that take a lot of their revenue, US dollar revenue, from exporting, and exporting that product that now you wish to tax at an end user level. So in my view, technology needs to help in this. We need to stop picking winners. There are many of these energy sources, in fact, are very complementary. So the areas we want to talk about the weakness of one energy source and why a particular energy source is better at it. Actually, when you join the two together, they almost offer a perfect combination of the two.
Give me an example.
Oh, very simple. Renewables and gas are very, very complementary. The areas where renewables are weak, gas is strong, and vice versa. I can start up a gas-fired power station very simply from my iPhone. You know, it's already set up to be started on a peak demand, peak shaving basis. It can go into load shed or into base demand. It can work very well with a renewable sink and renewable storage. So those sorts of things, it's the old hydro schemes and so forth that we used to have. So those sorts of things already exist in there. Yes, coal's got some flaws with respect to it needs baseload power, but you can build all of those layers up in the system and provide a reliable energy system that on an overall cost basis is the best one. The disruptions we've seen in the market have been price disruptions that have been driven by externalities where people have then had to go to a different pricing formula. Fukushima was a price disruption. Okay, it was a tragic event, but at the end of the day, it caused a price disruption, and it caused a geopolitical ripple effect around the world with respect to people's view on nuclear. Suddenly people were looking at different sources. The industry dined out on high gas prices for a while, but it drove the consumer to look for an alternative. And the consumer went and did that, and it went and developed gas resources coming out of the US that didn't exist before. And so what we need to do as an industry is design a future that's a sustainable future, that can flex up and down, and more importantly, can meet the long-term needs of the customer. We don't need this boom and bust. The boom and bust does no good for anybody. It destroys value in the long term. And we need to, maybe take the 3-iron out rather than the driver and go down the middle of the fairway, because we're hitting the rough too often in this industry. And we're doing it way, way too often. There'll be a point in time where investors will get sick and tired of us, or governments will get sick and tired of us, and they'll go somewhere else.
Actually, Charif, I'm curious about that. If you think the boom and bust, I mean, it's hard to imagine the industry without that central
From
narrative.
my viewpoint, carbon tax is the least of my concerns. I wish I knew what it was. Fred can argue with Patrick about whether it's $30 a ton, more or less. As far as I'm concerned, when I'm building my plans, it's immaterial. If I know what it is, I can handle it, and if it gives me visibility on a regulatory standpoint in terms of what it is that I'm expected to do, it's even better. I'm going to be more affected by seasonal variation, or how the weather is going to be, whether Scott Sheffield is going to find an even better way to produce the gas originally, whether whatever banker is in the audience today is going to raise interest rates to 200 or 300 basis points more or less. All of these things are going to have more impact on my business than a carbon tax. It's a real cost. It's a real cost of extracting hydrocarbons. I wish we would incorporate it into the equation and forget about it.
Interesting. It's an interesting view. So can I come back to a couple of the questions that I got on cards, which don't, but I do want to come back to this technology question because I think it's a really important one. So first, Peter, though, which is whether or not there's a recognition in the Australian kind of elite politicians, unions, that the industry needs to become much more competitive. Is that something that's been fully absorbed?
Well, I think the debate is moving on in Australia. We've just gone through a huge capital spend period, and the nature of the industry, if you think about the oil and gas industry, there's basically 3 business models these days. One is the very heavy capital upfront costs. Once those costs have sunk, then generally the operating costs of that is very, very competitive, very low. The other extreme, the other bookend, is the unconventional shale gas industry. Has a low upfront capital cost, but it's the gift that keeps on taking. It has multiples and multiples of capital you need to continue to plow into it each year, and it's very sensitive to that cost of capital over time. And it will set a floor. So actually what we're seeing is there is a gift that the US industry's given the world. They don't know it yet, but they've actually set a floor with respect to the LNG pricing, because the ongoing cost of getting that LNG pricing in the market's going to be set by Henry Hub in the future, and the processing fees coming out of those plants. So you've almost set a price here that has created a floor, a new floor in the marketplace once more and more of that volume gets into the market. So, from a technology point of view, as you think about how things are going to move on and what Australia needs to do, Australia's moving from this heavy capital mode, and of course government's now thinking about changing industrial relations law. Well, yeah, after we've spent the money. And it's now moving into an operating mode. So it needs to be much smarter as it moves into the operating mode. If you think about the invested capital in Australia, it's $150 billion of fresh capital that's gone in the last 5 years. The future is going to be data analytics, and it's going to be cognitive computing, additive manufacturing. And so if you think about those things, and it's something that the US is leading in many ways, but data analytics is going to be fundamental to having those plants running the very best they can. Cognitive computing or artificial intelligence is going to be the thing that will break the code with respect to the memory in the industry, the institutionalized memory in corporations and the ability to get repeatability into the things that we do. And then, of course, additive manufacturing, which our friends in Germany are leading in many respects with respect to the equipment, is going to be the things that breaks the cost curve with respect to the materials and so forth that we use in industry. And I think we're just starting to see that. But this pause actually provides us the time to do that, and it provides us the license to do that. We're not under the gun anymore of analysts who are looking for growth, growth, growth. So it's actually for those who can, those who've got the time and got the balance sheet capacity and got the wherewithal, now is the perfect time in the cycle to sit back and say, how can we crack the code as we go forward? There is a fundamental code that we need to crack here. And I think there's a code with renewables. We need to stop competing with renewables. We need to stop seeing it as a threat, and we need to see it as complementary to our offering, and we need to work together to see how the two can actually move into the future.
Yeah, very interesting. And I don't know, Fred, I'm just curious how you think about that. And also if you see, if you agree really with this sentiment that it should be like a puzzle piece where it kind of interlocks, and if so, in your mind, are there technology breakthroughs that are kind of right on the cusp that you think will lead to that future? That the audience may not be fully aware of or not as excited about as you might be.
Well, I think everybody is aware probably that storage is finally beginning to come down in price. There's a long way to go. Having said that, I do think I agree with the point that natural gas is, because it can fire up quickly, the fossil fuel that complements most easily with renewables that are intermittent. I think the one thing that people don't yet see so much of is that there's tremendous ability for, just as computing power has helped electricity over the next few decades, or electricity rather has helped computing power, now there's an opportunity for computing power to help the electric grid and seam in lower demands at certain times so that more renewables can be put in the system. Last point would be, we've talked a lot about risk to the natural gas industry, and I think one way to avoid risk is with smart methane rules because it extends the runway. But another way I do, because I agree with the point that governments aren't very good at picking winners and losers, I do think that's the advantages of these systems, whether it's a carbon tax or cap and trade, that allow the market to do that. Is you solve the problem and therefore you minimize risk, because mark my words, we are in the race of our lives, and with every passing month there's more evidence that the effects of climate change are really serious. So the demand for public policy vis-a-vis fossil fuels is going to get stronger and stronger. So smart methane rules at least extend the shelf life of that fuel, and pricing carbon allows that demand to be met, especially if it's coupled with a guaranteed declining cap on emissions. It allows the demand to be met without governments picking in winners and losers, which creates huge risk. Yeah.
And also, I mean, because I've been in the government on this, there's the regulatory just, the incentives get twisted when you put down whatever the number is, whatever the line is, right? People figure out how to navigate around it. So I can see there's this little overtime sign that keeps popping up. So I guess we're getting close to being over. But let me just look. One last question for the panel is if we, I really hope we're back at this 5 years from now, and maybe we can take like a tape of this and come back and see whether or not all the things that you've been talking about, whether they're unfolding or whether or not in fact we are, we're seeing a whole nother twist in the market. So before we just close, I just wanted to ask you guys, are you feeling like we're at the beginning of what is going to be now 10, 20 years of just incredible disruption to the point that, yes, we could not have this conversation 5 years from now and be really having the same conversation? Or do you think there's just a natural, we're overplaying it this time and we'll be back to kind of the normal market a few years hence? So.
What a really good question. I hope you don't play it back at me.
No, I'm going to. Are you kidding? I'm taking.
Yeah, look, we're certainly I look at it in 5-year periods. So we're certainly into a period of uncertainty. There's no doubt about that. There's new volumes coming out of the US. We're not sure how they're going to get soaked up into the market. Everybody says Europe will be a sink. I'm not sure whether it will or how much of a sink it can be. I don't know how much will go into Asia. I don't know how many of those plants will actually run at full capacity. I mean, there are other options there. So all of that will play into it. Where's new demand going to come from? We haven't really talked a lot about India and the policies in India. India is extremely price sensitive, and there is a point right now where gas is very, very competitive with coal in India. You need to look at where coal is produced from, who are importers, who produce coal internally, and how that drives jobs and which economies will be willing to make those particular changes. So all of that says we're in for a heck of a ride. This is really going to be fun. Those companies that will survive and, more importantly, thrive are the ones who are able to adapt to the changes in circumstances. Those who lock in on a particular vision of the world, 1 out of 10 of them will do well because they may have picked the right one. The other 9 will lag behind, and we'll be talking about them as former companies. Yeah. And so that's where I really think we are. Well, we're working really hard for it not to be. So I think we're at a point in our industry, we've been through it before, but we're at a point where the margin for error is pretty small. We need to be very careful.
I think the biggest change over 5 years will be that the industry finally gets away from the idea that energy is something that's scarce and therefore inevitably going to become more expensive over time, and realizes that we're into an age of plenty, where because of technology and because of public policy mandating part of the market, we will have more energy supply than demand. And I think if we meet in 5 years' time, under Jason's leadership, it'll all be about how the energy business copes with long-term low prices across the board.
I think the missing element is volatility. The shale revolution in the United States has introduced a measure of volatility in the world natural gas and oil markets that was unprecedented. So you can now go from peak to trough, if this is the trough, in about 18 months, and probably, in spite of what everybody says, from trough to peak in another 18 months. So we now have very short cycles, and you have to make 20 years investments with prices that go up and down every 3 years. And in that context, the business models that are currently in place don't work. So you've got to come up with a new model that addresses this kind of volatility.
One way or the other, I think in the next 5 years, we will see a surge in the number of countries and economies that do put a price on carbon using one technique or another. We already have 25% of the world's GDP using a price on carbon. So we are well on our way to many, many more, and it'll be a good thing.
Okay. Well, thank you. Thanks. Let's thank the panel. Great conversation. Thank you.